Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. Starting from this video, we are going to discuss Chapter 9, Reporting and Interpreting Liabilities. Let's get started. The learning objective for this chapter is the following. After starting the chapter, you should be able to define, measure, and report liabilities. We will also be talking about notes payable and contingent liabilities in reporting and also explain the importance of working capital. In this particular video, I'll talk about liabilities in terms of concepts, and I'll introduce the concept of working capital. Let's first talk about liabilities. When we talk about liability, we have to understand from a bigger picture where our liability is coming from. In the first chapter, we talked about the accounting equation. In the accounting equation, asset equals to liability plus stockholders' equity. Effectively, the accounting equation told us the resources a company owns, which is the assets, equals to borrowed resources, which is the liabilities, and owners' invested resources, which is the stockholders' equity, or the stockholders' claims. So now this comes to capital structure, because in order to fund our assets, we have a structure which is basically the proportion of liability and stockholders' equity. For example, a company could be funded 60% from stockholders and then 40% from the creditors. This 40% to 60% split, or whatever the ratios are, like 30% to 70% splits, they reflect the manager's choice between debt and equity. So company managers consider two key factors when they borrow money: risk and cost. From the firm's perspective, debt capital is more risky than equity capital, because payments associated with debt are a company's legal obligation. If a company cannot repay a debt, either for the principal or for the interest, because the company has a temporary shortage in cash, the company may be forced to go bankruptcy. And creditors can also force a company to sell its assets to repay the debt. As with many business transactions, borrowers and lenders attempt to negotiate the most favorable terms possible. Managers devote considerable efforts analyzing alternative borrowing arrangements. On the other hand, the manager can always choose to fund from the owners, which we are going to talk about in Chapter 11. Now let's formally define liabilities. Liabilities are the probable future sacrifice of economic benefits that arise from past transactions. Note that there are two key points here. First, liability is an obligation in the future, which requires a sacrifice of economic resources. Second of all, liabilities are associated with past transactions. On the balance sheet, liabilities are ordered by their maturity. If a liability matures in 1 year or less, they are classified as current liabilities. If a liability matures in more than 1 year, they are classified as long-term liabilities. Let's first take a look at current liabilities. Most of the current liabilities has a direct relationship with our operations. So here are some examples. For example, if a company purchased coffee inventory, this would be associated with accounts payable. When the company purchased the inventory, the company would debit inventory, credit accounts payable. If a company rent a space for a coffee house, the company would accrue rent, which means the company does not pay the rent upfront or at the point, but paying the rent later. When that happened, the company would debit rent expense and credit rent payable. Now, rent payable is a current liability because it has to be paid within a year. When employees earn wages, the company would accrue wages and include it in accrued liabilities. The company would most likely debit wage expense, credit wage payable. Finally, customer pays in advance for future purchases. If you remember, this is something called unearned revenue because the customer pay in advance, then the services are provided. So the company would debit cash when the cash received from the customer and then credit unearned revenue or deferred revenue. Now, unearned revenue, although it has a revenue in its name, it's not a revenue account. It is a liability account. One more point to make. Accounts payable is an important account under current liability because accounts payable are most likely related to the day-to-day business operations, so it is also called trade accounts payable. Trade basically means day-to-day operations. So these are a couple of the commonly seen current liabilities. Accounts payable, which is obligation to pay for the goods and services used in the basic operating activities of the business. Accrued liabilities, obligations related to expenses that have been incurred but have not been paid at the end of the accounting period. Deferred revenues are the obligations arising when cash is received prior to the related revenues being earned. Notes payable are obligations supported by a formal written contract. Some other examples of short-term or current liability include accrued taxes payable. So a company uses government services and at the end of the period, the company owed taxes to the IRS that would be reported under the accrued taxes payable. A company may also owe workers money, which is just a short period of lag, but according to the matching principle, companies record expenses for the works that the workers done at the end of the period before they pay those workers. So those unpaid salaries or benefits are accrued compensation. There's another type of taxes that everybody pays. Say if everybody may have some working experience as a part-time worker, right? If I work for McDonald's and help to serve some meals, at the end of the day, when McDonald's tries to pay me, they will only pay me a net amount, which subtracting all the which we call payroll taxes, including the Medicare, Social Security, and so on and so forth. So that portion McDonald's deducted from my payroll is called the payroll taxes, which is associated with my future benefits in the Social Security program. The last one is very peculiar. This item is called current portion of long-term debts. So imagine a company borrow a loan for 5 years. Now, if a loan is mature in 5 years, this loan is not counted as current liability. However, when time passed by, say 4 years passed by, now the loan is in its 5th year, which means the loan is going to be due in a year because next year is the end of the loan's maturity. When that happens, we need to reclassify that 5-year loan in its last year to be under the current liabilities and call it current portion of a long-term note or long-term debt. This practice reflects that the accountants are very peculiar about when a loan or when a debt should be classified as current versus long-term. Now let's talk about long-term liabilities. Long-term liabilities include all obligations not classified as current liabilities, such as long-term notes payable and bonds payable. So firms can raise money from different ways. I mean, in terms of the long-term liabilities, companies could raise capital from financial services organizations in a private placement, which is notes payable, from the banks, the insurance company, and the pension plans. A company could also raise from the open markets, which is publicly traded in the market. Those are bonds to the market or bonds payable. So notes payable and bonds payable are the two major items under long-term liabilities. Finally, it comes to an important concept in accounting called working capital. working capital equals to current assets minus current liabilities. Now, working capital is an important concept because working capital tells us how liquid the company is, or what is the liquidity of the company. Now, what does liquidity mean? Liquidity means that if a company has the ability to repay its current liabilities, the company has liquidity. This comes back to the idea of current asset and current liabilities. Current liabilities are the obligations that we have to meet within a year. And current assets are the assets that can be converted into cash within a year. So you need to have sufficient current assets to cover the amount of current liability a firm has. That's why working capital has a significant impact on the health and profitability of the company. Changes in working capital accounts are important to the managers and analysts. They would try to look at the change of working capital or the change of current asset versus current liability to try to determine how healthy the firm is. In the next video, I'm going to talk about some detailed accounting treatments for some of the loans. You should watch McGraw-Hill Guided Help video 9-1, which will talk about how working capital would have an impact for the cash flow of the firm. I'll see you in the next video.